Will the market continue to crash in this crazy jumping bean kangaroo market? What triple leverage inverse funds am I daring to invest in? What stocks look like interesting possibilities to look into to possibly invest in? Buckle up and hang on. It's going to be a wild ride, folks. This is not financial nor professional advice. This video is for entertainment only. Hey everyone. The path towards recession looks certain, and it might be a path towards depression. One sign of that is how much oil has come down. Oil used to be well above $120 a barrel, and now recently it's been below $78 a barrel. Wow. So commodities are all dropping in price, it seems like. And it's because of the destruction of demand caused by higher interest rates, which is destroying the demand just like they want. The Federal Reserve actually wants the stock market to crash. It's the easiest way for them to prevent inflation with hurting the least people, because a lot of people do not own stocks. I believe that Tesla and Apple are mainly holding the market up and keeping it from doing a super crash. Tesla's gone down another 10 points. It's now fighting at the 280s, and Apple is fighting at the 150s, where it's been fighting for some time. So that tends to be a major area of support. But should those start to go below those figures of 180 for Tesla and especially 150 for Apple, if that happens, the market could take the big swoosh. And if it takes the big swoosh, it could go down significantly. Some are saying that Tesla could go down by 50%. I don't think it's going to be that extreme, but it will be noticeable. And if Tesla loses major support, let's say at like 240 or something around there, we are in real trouble. There is good news on the electric vehicle front. There's a company called Adden, Adden. It's a privately held company, but the reason I mention it is they think they've found the solid state battery. They've gotten to the point where it can be charged in 3 minutes and that it'll last for 20 years, which would be so significant. If it were a public stock, I would certainly look into it and buy it. But right now it's privately held. But it shows how fast that area is developing and possibly what we have to look forward to if this is more than a rumor. Mortgage rates have gone well over 6% and are headed towards 7%. The last I heard, the highest one I heard was 6.87% on a 30-year fixed rate mortgage. So the mortgages are getting to the point where they're going to crash the real estate market. And I've invested in a triple leverage inverse fund, DRV. You make $3 for each dollar the real estate index goes down, and that has been very profitable, exceedingly so. I invest in the VIX through the symbol VIXY, VIXY, and that's been a profitable investment, although it's not nearly as excited as my triple leveraged funds. I'm getting so addicted to them. The triple leverage funds, I had $200,000 or $300,000 losses at let's say around March or so. And since April, I've been doing the triple leverage funds, and I've made up for those losses. Plus, I've made another $440,000. So, am I high on inverse triple leverage funds? I guess you would say yes. It is said that the Federal Reserve will hike interest rates until something breaks. And everything is breaking except the dollar, which is breaking everything outside of the United States. It's actually good for the United States because the United States citizens can buy, and factories and businesses and commerce can buy products cheaper outside of the country. So it tends to be good for our purchasing, but we're going to have an awfully hard time exporting because our products will be so much more expensive to other countries. And the 10-year bond is getting close to paying 4% interest. Right now, it's paying 3.96% interest. So now there is an alternative to stocks. People compare how much stocks pay on dividends, comparing that to the 10-year rate, and the 10-year rate is starting to come out favorably. And if this continues, and the Federal Reserve has promised that they're going to increase rates by at least 1% more, they have promised this. You're going to see people start to buy bond funds as a part of their investments, as a part of their hedging. In fact, in the old days, it used to be said that you should have 60% stocks and 40% bonds. Well, nobody's been doing bonds for the last 10 to 15 years simply because there's no way to make money with them. But now, actually, the interest rates are getting to the point where you could make some money, or at least use it as a partial hedge against the great flush. We've gotten a real triple whammy in this economy. First, there were the health problems, which led to outrageous loose monetary policy, which we're paying for now. So it's the health problems, the monetary policy, and then we got this weird war of Russia invading its neighbor that it had no reason to do. So we got this weird combination of circumstances. And I think that war could actually start to reverse if it would suddenly come to some kind of solution where the fighting stopped and the commerce was able to flow and Ukraine was able to rebuild, and they decided to get along peacefully with Russia, and Russia agreed to get along peacefully with them, that I think we would have an unprecedented boom. The dollar is so strong that it's a problem. The British pound is in danger of falling below parity with the dollar. I went to London a couple years ago, and I remember the exchange rate for the US dollar was between $1.20 and $1.30, something like that. You'd have to pay $1.25 to get 1 British pound. And now there's danger that it could cost less than $1 for you to buy a British pound. So that's a major devaluation, but it's good for a trip to Europe if you want to get a trip to Europe cheaper. And it's good for getting a lot of other goods cheaper, but it's really hard on the Europeans. At this point, I'm somewhat addicted to triple leveraged inverse funds. My favorites, of course, are SQQQ. That has been the greatest. It's made over 30% in the last month. This is the kind of returns you can get with these. Also DRV, because real estate is crashing, and I think it could crash harder than I predict. I predict 20%, but it could be worse than that. The other one is Yang, YANG, which is a triple leverage inverse fund on Chinese stocks that trade on the American stock exchanges. And they've all gone up in value and have been positive. But my favorite is SQQQ. I'm so familiar with it. I know pretty much how it tends to go. I will miss occasionally, but the hits are much more than the misses. And the DRV, that seems like the easiest and the most certain in my mind, simply because the increase in real estate mortgages, that has to crash the real estate market to an extent. And it might be a greater extent than what I've been predicting. There's 4 stages to a bear market. The first stage is recognition. Okay, it's recognizing the problem that we're actually in a bear market now. It takes a while to fully believe it, okay? The second stage, and we're in this stage now, is the panic stage, where prices actually begin to fall precipitously, and there's bear rallies and fits and starts. But it falls quickly enough that people are in a general panic, and everybody's pretty much bearish, and the market continues to go down. The third stage they call stabilization, and that's where I would say the market sort of barcodes. It sort of goes up with bear rallies at times and then goes down, but the trend is downward. It's just doing it somewhat more gradually than in the panic stage. I like to refer to the stabilization stage as the grind down stage. And it's actually the most painful part, because you keep hoping that it's going to grab one of these rallies and keep going forward. But actually all it does is it keeps grinding you down. And then the fourth stage is the anticipation stage. And this is where there's signs of hope that it's ending. And you get brief pop-ups. And I usually look for there to be a 5% or so pop-up before I believe that we're coming out of the bear market. So that's usually how I play these things. I've noticed that many commentators are starting to talk about bank failures. Now, when you start talking about bank failures, the word depression starts to enter my mind as an economic possibility. But a way to benefit from bank failures, as morbid as that is with a triple leverage inverse fund, which is FAZ. FAZ is a triple leverage inverse fund on the Russell 1000 Financial Services Index. And so it includes things like banks and anybody that provides financial services. And it's widely dispersed among smaller type companies for the most part, since it is involving 1,000 companies on the Russell. You know, technology has really been taking it in the teeth. And there is another inverse fund, a triple leverage inverse fund on the Russell 1000 Technology Index, and its symbol is TECS. And I think that will show, just like SQQQQ has shown, is showing the pain that the technology sector is going through, and would be a good investment that I am thinking of investing in. So how long is this going to continue, this crash? It all depends on inflation in my mind. We're transitioning from inflation to a recession and possibly into depression. I think the Fed wants to prevent depression, but they're mainly focused on the inflation now. They want to see that that is a problem that can be cured. And until they're convinced of that, they're going to keep raising rates. And so until the Fed stops raising rates, we're likely to continue this onward crash. The Fed wants it to crash to an extent, but not horribly bad. And so to walk that line is very difficult. And I wish them the best of luck, because it's all tied up in what's going to happen to us. There are ways to benefit from these terrible events and to prepare yourself for a time when you can invest in growth companies without worried about losing a third of your investment. Thanks for listening and watching. Be sure to like and subscribe. Hit the notification bell so you're notified of future videos. And good luck to us all. Thank you.